Welcome to Capital Allocation Lab, where we revisit timeless investing ideas and translate them into practical decisions for today's long-term owners. We are diving deep today into, well, one of the most critical decisions any long-term investor faces, really. It's about choosing and then, crucially, managing an investment advisor.
If you find these lessons useful, please subscribe and tap like so more serious winners can discover the channel.
Our mission is crystal clear. We really want to improve your judgment. We offer clear frameworks you can use immediately, but you won't find any hype here, no trading signals, and absolutely no forecasts. That's not what we do.
Today we're exploring that foundational relationship, the investor and the advisor. We need to define when using an advisor actually adds genuine value, how you choose the right partner, and, this is critical, how you use that advice without, perhaps unconsciously, just surrendering your own judgment and responsibility.
Yeah, that's key. So we're going to try and install a simple operating system for advice, as we call it. This system is really designed to maximize the benefit, minimize the potential harm, and crucially, align incentives so that your financial structure is secure, no matter which way the market moves.
Okay, let's start with what makes this investing relationship so unique and often so difficult.
Yeah.
In most fields, when you hire an expert, the job seems pretty straightforward, right? You hire a roofer, they fix the roof. A tax lawyer handles the return. Competence, completion, that's the expectation.
Right, get the job done.
Exactly.
But with investing, there's often this unspoken thing, isn't there? This secret job many people hope to outsource. Make me above average money, but without taking above average risk. And that right there, that's where the conflict often starts.
It really is. It's the source of almost every disappointment, I think, in the investor-advisor relationship. When we start with that expectation that an advisor should somehow deliver more than standard risk-adjusted results well, we're demanding something that just can't be reliably promised or delivered. The valuable role for a financial advisor is actually much simpler and much more robust. Their job is to protect you from costly self-inflicted mistakes, maintain the soundness of your long-term plan, and deliver results that are consistent with your explicit goals and, importantly, your capacity to endure risk.
Okay, so we need to sort out those expectations right away. It sounds like there are two very distinct lanes, two paths of service, and you absolutely have to decide which lane you're driving in before you even think about interviewing anyone.
Precisely. Let's call them Lane 1 and Lane 2. Lane 1 is focused on achieving, let's say, standard results with fewer errors. This lane is achievable, it's teachable, it's repeatable, and frankly, it's realistic for the vast majority of long-term investors. If you choose this path, you judge advisors primarily on, prudence, their clarity, how well they communicate, and their financial alignment with you. Are they on your side? This is really the path of compounding by avoiding catastrophe.
Avoiding the big mistakes.
Exactly.
And then there's Lane 2. Try to beat the market. Now, when you sign up for this, you're not just looking for standard compounding. You are explicitly looking for genuine outperformance, better than average.
And that expectation immediately requires two things. First, exceptional skill from the advisor, truly exceptional. And second, unusual, almost unnatural discipline from you, the client. Even if you have both, the odds are still long and the ride is absolutely guaranteed to be uncomfortable at times.
Okay, so if you decide you want to live in Lane 2, what does that demand from you?
It demands that you develop sufficient competence, real, fundamental analytical skill, enough to independently evaluate the advisor's unconventional recommendations. Otherwise, you're just paying to rent someone else's confidence, And confidence alone isn't a sustainable edge.
And that discipline part.
Unusual discipline here means something specific. It means maintaining conviction, real conviction, on maybe a controversial idea for perhaps 7, maybe even 10 years, often through periods where the market is screaming that you're wrong.
Wow. Okay. So that clarity Lane 1 or Lane 2, that's maybe the most vital self-assessment you can do.
Absolutely.
And once you know which lane you're aiming for, then we can start mapping the advice marketplace. You mentioned 5 common sources, and each has its own potential pitfalls.
That's right. We need to learn how to use the information from each without getting hurt by the inherent conflicts. The first, and probably the most accessible source, is bucket 1, relatives and friends.
Ah, yes. The kitchen table advice.
Exactly. The upside is obvious. You have trust, hopefully, and they have context about your life, your job, your family. That's valuable.
But the downside feels pretty big, too. Overconfidence, maybe. Basing advice on their one lucky stock pick.
Precisely. Overconfidence, tiny sample sizes, emotional attachment, it's all there.
Yeah.
So the rule here is, use this bucket strictly to pressure test your own thinking. never to outsource the actual decision. And if their pitch hinges on some can't-miss story, or it's all about near-term price action.
Reject it. That sounds like entertainment, maybe speculation, but definitely not sound financial advice.
Exactly right. Okay, next is bucket 2, commercial banks and trust departments. These institutions are, almost by design, conservative. Their policies lean heavily towards capital preservation. They tend to favor high-quality bonds, broadly diversified funds.
So their strength is really that institutional discipline process.
Yes, discipline and process are their strength. They're built to avoid those huge, regrettable errors, the kind that could really derail a financial future.
But that discipline is also, well, a limitation, right? They're not really set up to surf market cycles or make aggressive, opportunistic bets.
Correct. They're designed for steady safety, for adherence to a defined, usually conservative plan. If preserving capital and just sticking to a long-term default position is your absolute highest priority, then this kind of structural approach could be very, very powerful.
Okay. Moving on to bucket 3, brokerage firms. Now here, you said there are 2 distinct roles.
You have the broker, who typically executes orders and might offer some general guidance. And then you have the research analyst, whose job is to study businesses and securities in depth. You can get excellent information here, really valuable insights. But the structural incentives are clear. They often revolve around transactions, buying and selling, and gathering assets under management.
Right. Activity benefits them. So the investor's defense mechanism has to be just absolute clarity from the start.
Yes. You must define, preferably in writing, the specific kind of ideas you want. Maybe it's deep value, long-term buy and hold, whatever fits your philosophy. And then you have to be really firm about declining anything that sounds like short-term trading or, the hot tip of the week. Their potential need for activity must not override your fundamental need for patience.
Got it. Okay, bucket 4.
Bucket 4, financial services and periodicals. Think research digests, ratings agencies, data terminals like Bloomberg, newsletters, that whole ecosystem.
How should we use those?
They are most useful for raw information and for providing checklists, things to make sure you've considered in your own analysis. They should almost never be used for specific buy or sell commands. Don't just blindly follow their recommendations.
So use them to build your own picture of a business.
Exactly. Build your own comprehensive view. The risk here is letting them shrink your investment horizon down to just the next quarter's earnings report or the latest rating change. They are tools for analysis, not substitutes for your own thinking.
Okay. And the last one, bucket 5.
Bucket 5, independent investment counsel or planners. Now, this often represents the best path for those firmly in lane fine. 1, the investor is seeking a steady policy, reliably enforced by a third party. The best professionals here. They tend to exhibit a certain modesty in their promises. They focus relentlessly on building and then enforcing a comprehensive plan that you can actually stick with, live with, through a full market cycle.
So their edge isn't predicting the market's next move.
No, not at all. Their edge is behavioral enforcement, helping you stick to the plan when things get tough. And that modesty I mentioned, that's a really key sign of quality in this category. Look for it.
Okay, we've mapped the sources, which is helpful. But that map is kind of useless until we know where we stand, right?
Exactly.
So let's pivot to what you called the most important assessment, self-assessment. Before you even think about interviewing an advisor, you have to determine, are you fundamentally a defensive investor or are you truly an enterprising investor?
And this choice, it has to fit your actual calendar, how much time you really have, and your character, your temperament, not just your ego or what sounds impressive.
Because it's a commitment.
It's absolutely a commitment to a way of life, a way of behaving, especially when markets get really difficult.
Okay, let's define the defensive investor first. Who is this person?
This individual is primarily seeking standard, market-appropriate results. They want minimal fuss, minimal involvement, and crucially, minimal decision-making stress.
So what should they demand from an advisor or from their own process?
They should demand what we might call boring excellence. Think fully diversified, low-cost core holdings, simple automatic rebalancing, and maybe most importantly, an advisor who acts primarily as a guardrail and a simplifier, someone whose value often comes from saying no.
No to complexity, no to chasing fads.
Exactly. They prevent you from doing anything impulsive, overly complicated, or just plain stupid, frankly.
Now contrast that with the enterprising investor.
Right. This person is different. They are willing and able to commit significant time, ongoing training, and that disciplined temperament we talked about, all in an effort to potentially go beyond standard results. But here's the key. They must earn the right to even attempt harder things. It's not automatic.
Earn it how? What does that earning process look like?
It's rigorous. It means building real analytical skill. It means keeping absolutely meticulous records of every single decision, especially the losses, not just the wins. And it means insisting on doing thorough, independent valuation work before taking any action. No shortcuts.
You mentioned a critical self-check for the aspiring enterprising investor. Can you repeat that?
Yeah, it's deceptively simple but powerful. If you cannot explain your specific investment edge, what you know that others don't, how your analysis differs, why your approach should work in one single concise paragraph, then you probably don't actually have an edge yet. In that case,
Default to defensive.
exactly, default to the defensive strategy until you genuinely build that core competence. Don't pretend.
And if an enterprising investor does hire an advisor, what's the advisor's role then? It's different from the defensive model.
It shifts dramatically, yes. They're no longer just a guardrail. Now, they act more like a sparring partner, someone to challenge assumptions, and also a speed governor, making sure that confidence doesn't bleed into recklessness.
Got it. But again, the first step is defining yourself and choosing the identity you know you can stick with when the world feels like it's falling apart, because that's when it really matters.
That's precisely it.
Okay, whether or not you decide to hire a professional advisor, you argue that every serious investor needs some kind of structural integrity. You call this the advice operating system, the AOS.
That's right. Think of it as the essential foundation. It consists of 5 critical files, let's say, that bring discipline and clarity to your entire financial life.
Let's break them down. File 1, the Investment Policy Statement, IPS. This sounds formal, but what is it really?
Think of it as your personal financial constitution. It must be written down, and it needs to be in clear, plain language, not jargon, easily readable by you, by your advisor if you have one, and maybe even by someone who might eventually inherit your assets. Simple, clear, direct.
And what absolutely has to be in it?
Okay, key ingredients. Your objective specific goals, not just make money, your constraints, things you can't or won't do, your time horizon, clear limits on risk, how much can you stand to lose, also what asset classes you will own and why, the specific rules for rebalancing back to your targets, and maybe the single most powerful part.
What's that?
A clear list of what you will never do. I will never use margin. I will never invest in things I don't understand. That pre-commitment written down when you're calm is incredibly powerful for preventing emotional mistakes later.
Okay, that makes sense. File 2.
File 2, the Asset Allocation Map. This is like the blueprint, the visual representation of your strategy. It specifies your current weights and your target weights for equities, bonds, cash, any alternatives you might hold. And critically, each weight must have a clear, logical reason behind it, tied directly back to your IPS and your needs, not tied to your mood or your feeling about whether the market's going up or down next week.
And you mentioned a critical component here, linking the map to behavior.
Yes, the drawdown budget. This is absolutely vital. It's the maximum portfolio fall, defined clearly in dollars, not just percentages, that you believe you can tolerate without panicking and abandoning your entire plan.
So it's not just a number, it's like your predefined panic threshold.
Exactly. It's knowing yourself. If your $1 million portfolio drops to $800,000, you need to have decided in advance that you won't call your advisor screaming, sell everything.
Right. That $200,000 number, seeing it written down, gives you that pre-committed emotional anchor. It helps you respect your own risk capacity when fear is absolutely screaming at you.
Precisely. It's a behavioral tool.
Okay. File 3, the Decision Journal. This sounds potentially tedious. Why is it so important?
Think of it as the lie detector for your investment decisions. It's where you capture why you did something at the time you did it. Good or bad decisions, doesn't matter. Record them.
Why is that so crucial? It stops you from, what, rewriting history in your head.
Exactly. It stops retrospective rationalization. We're all brilliant in hindsight, right? So when you add or remove a holding, you must document. What's the thesis? What cash flows did I expect? What valuation did I assign? And critically, what specific facts or evidence would prove my thesis wrong? What are the disconfirmation triggers?
Because if you don't write down why you bought it,
you'll never have a rational basis for when you should sell it, other than price movement or emotion.
Got it. Okay, file 4. Risk and behavior guardrails. These are like hard rules.
Yes. Your non-negotiable pre-commitments, designed purely to protect you from your own worst impulses. You need to list specific, actionable limits. Things like no margin debt, ever. No single stock position over, say, 10% of the portfolio. Or maybe no trades based solely on price action or chart patterns. Make them explicit.
And you have a favorite guardrail you often mention.
Yeah, the simple one. No investments I can't explain clearly to a teenager.
Why that one?
Because it forces simplification. And simplification, understanding what you own, is maybe the ultimate form of risk control. If you can't make the thesis simple and clear, you probably don't understand the business well enough to own it.
Makes sense. And the last file, file 5, roles and meetings.
This is the accountability file. It's about process. Define clearly who does what, the client, the advisor, the accountant, etc. Spell it out. Then establish a mandatory meeting frequency, quarterly, annually, whatever makes sense. And crucially, every meeting must have a defined standard agenda.
What should be on that agenda?
Key sections should include reviewing progress versus the defined goals in the IPS, a formal risk review, are we still comfortable, an audit of all fees and taxes paid in dollars, a discussion of what has changed in the environment or our assumptions versus what hasn't, and always end with clear action items, assigned owners, and specific due dates. This systematic approach ensures accountability, keeps things focused, and prevents meetings from just devolving into emotional chats or market gossip.
Right, structure and accountability.
Exactly.
Okay, so installing that AOS means your own financial house is starting to get in order. That's the foundation. Now let's talk about actually vetting an advisor if you decide you need one. And you said the single most important rule in finance is
Follow the money. Always, always follow the money. Incentives drive behavior. They ultimately explain outcomes more reliably than almost anything else. So your core question, the one you have to ask relentlessly is, how do you get paid? Is it by me, the client, only? Is it based on transactions? Do you get paid by third-party product providers? Is it based on the assets you manage for me? You absolutely must follow that money trail to understand the structural biases inherent in the relationship.
Okay. Now, I know that fee-only fiduciary models are generally seen as structurally simpler, maybe less conflict-prone.
Generally.
But let's be realistic. Many investors work with commission-based providers for various reasons. If someone chooses that route, what's the non-negotiable action they must take to try and mitigate that inherent conflict?
They must demand, and I mean demand, preferably in writing, that the provider evaluate every recommendation against readily available, lower-cost, conflict-free alternatives. Things like broad, cheap index funds. And the provider needs to clearly document why the recommended product, often more expensive, is genuinely superior for the client's specific situation. And the investors should be checking this themselves periodically. It forces transparency and accountability into the conversation.
And that transparency has to extend to the actual costs, right? Not just percentages.
Absolutely non-negotiable. You must insist on getting a simple one-page fee table. It needs to clearly itemize and show all the costs you're paying, in dollars. If the advisor struggles or refuses to translate, say, a 1% management fee and a 0.5% average fund expense ratio into a hard dollar cost based on your specific portfolio size, well, the relationship is already compromised. If you can't see the dollar cost clearly, you can't properly evaluate the economic value of the advice you're getting.
Makes sense. And finally, before even getting into the interview, expectations need to be aligned upfront, right?
Critically important. You need to reiterate that your goal is not beat the market every single year. That's unrealistic. The goal is stick to a sound process, avoid costly behavioral errors, and compound my wealth at a rate consistent with my financial needs and risk tolerance. If they start promising consistent market outperformance right out of the gate, they're already misaligned with the sustainable long-term process. That's a red flag itself.
Okay. So to really get the unvarnished truth about an advisor's integrity, their process, you need a disciplined interview script.
Yes, you need to go in prepared. Use the script, take detailed notes, and critically, learn to use silence. Ask the question, then wait. Silence often forces much more revealing elaboration than jumping in too quickly.
All right, let's run through those 7 key questions you recommend, the ones that really reveal the truth.
Okay. 1. Mission and match. We want to understand their fundamental purpose, their why. So ask, what change in a client's life are you ultimately trying to create? And tell me a story, a specific example of a client you're most proud of helping, and maybe also one where you realized, looking back, you just weren't the right fit.
That second part, the mismatch story, that sounds really revealing. It shows self-awareness, selectivity.
Exactly. It reveals their capacity to understand their own limits and who they can genuinely help versus just taking on any client who walks in the door.
Okay. Question 2.
2. Philosophy and evidence. Go beyond vague statements. Ask, what do you fundamentally believe about how markets work that you think most other people ignore or get wrong? And then, crucially, show me using real aggregated client composites or model portfolio histories exactly how those core beliefs actually show up in the portfolios you manage. You need to see proof of consistency between words and actions.
Right. Evidence, not just talk. 3, process under pressure. This feels like maybe the most vital question because anyone can look smart in a bull market, right?
Absolutely. So you ask, describe a specific time when markets were really painful, maybe a 20% or 30% drawdown. Tell me exactly what you did, specifically before the drop, during the worst of it, and after things calmed down, to keep your clients sticking to their long-term plan. You need to hear concrete details about their communication, their actions, their behavioral coaching during stress.
Okay. 4, conflicts and costs. Time to be direct.
Very direct. And demanding. Ask, please list all the ways you get paid. Who else, besides me, pays you for anything related to my account? And show me, based on my potential portfolio size, exactly how much I would have paid last year, broken down in dollars advisory fee, underlying fund expenses, trading costs, any planning fees. I need the total dollar cost, ideally on one single sheet.
No ambiguity there. 5, role clarity. Who does what?
Precisely. Ask, what decisions will you make autonomously? What decisions are ultimately mine? And how will we formally handle disagreements if they arise? Critically, what specific action or request from me would cause you to say no?
That last part really gets at their willingness to enforce discipline, even against the client's impulses.
Yes. It reveals if they see their role as just order-taking or actual advising, which includes protecting you from yourself sometimes.
6, reporting. How will you know what's going on?
Ask them, show me a sample client report. Looking at it, I should be able to clearly understand my net performance, all contributions and withdrawals, the total fees I paid, and the tax implications, all in under, say, 2 minutes. If the report is overly complex, confusing, seems designed to obscure costs or benchmark comparisons, that itself is a clear answer. Complexity often hides problems.
Good point. And finally, 7, diligence. Just basic background checking.
Yes, demand they provide, your official regulatory filings, like the Form ADV, contact information for several long-term client references I can speak with, and a transparent summary of any past client complaints or regulatory issues and exactly how they were resolved. This is just standard professional due diligence.
It seems like a truly trustworthy professional, someone aligned with your interests, would actually welcome this level of detailed scrutiny.
They absolutely should. Evasion, defensiveness, or vagueness on any one of these 7 points is itself a huge red flag. It's a definitive answer, and you need to listen to it.
Okay, let's turn now to specific language to listen for. The red flags. You call it the language of regret phrases and behaviors that reliably predict future pain.
Yes, listen very carefully. If you hear these exact terms, your alarm bells should go off immediately. Slow down or just walk away. Phrases like guaranteed returns, absolutely no downside, our proprietary model simply can't lose, anything involving offshore structures without clear reason, talk of prime bank instruments.
Sounds almost too good to be true.
Exactly. Also, exclusive allocation or any pressure tactic like, you need to hurry on this one, the opportunity won't last.
No, wait a minute. What about we can beat the market? Isn't that essentially the implicit or sometimes explicit promise of every active manager, especially those in lane 2? How do you separate dangerous hype from a manager who genuinely believes in their edge and process?
That's an excellent and subtle point. The key difference lies between confidence backed by process and a guarantee or unrealistic smoothing. A good, honest manager might say something like, based on our rigorous, reputable process, we believe we have an analytical edge that should lead to outperformance over a full market cycle, maybe 5 to 7 years. But this requires patience, the ride will be bumpy, and the risk of underperformance or even loss is absolutely real. A bad manager or a salesperson masquerading as one says things like, we can't lose, or we will beat the market consistently. Or they use language designed to imply unrealistic smoothness, like, our monthly returns are smooth as glass. That's a huge red flag.
So beware of certainty and smoothness.
Yes. Add to that list phrases like, the upside is potentially huge, often without quantifying the downside. Or the simple chilling phrase, just trust me. Your financial future deserves clear documentation and process, not blind trust.
And besides specific phrases, what about behaviors? Behavioral red flags.
Watch for anyone rushing you through documents. Pressure to move assets before the plan, the IPS, is fully understood and agreed upon. Any reluctance or inability to disclose total costs clearly in dollars. Or someone dismissing the fundamental need for a written investment policy statement as unnecessary paperwork. Patience and paperwork are definitely your friends in this process. Haste and vagueness are your enemies.
Okay, let's say you are that enterprising investor. You're willing to do the work, and maybe you choose to work with a brokerage firm's research department or use sophisticated analysts. You said you have to draw a very bright line.
Yes, an explicit line between receiving ideas or information and actually executing orders to buy or sell. They are not the same thing.
And this boundary needs to be communicated clearly, preferably in writing.
Absolutely.
Yeah.
Tell your broker, put it in an email. I am a long-term fundamentals-focused business owner. I do not use margin. I do not trade options for speculation. I do not engage in short-term trading based on news flow. What I require from you are in-depth business analyses focusing on plausible valuation ranges based on cash flows and clear identification of the key risks. I am not interested in short-term press targets or technical chart patterns. Set the expectation up front.
And when you do engage with a research analyst, maybe talk about a specific company. You need to shift the conversation away from just, is the stock going up?
Immediately. Shift it towards foundational financial reality. Force them, gently but firmly, to think like a long-term owner or a potential buyer of the entire business, not just a trader of the stock ticker.
So instead of, is it going up? What are the kinds of questions that force that fundamental thinking?
You need to ask things like, okay, looking out 5 years, what's a reasonable midpoint estimate for the normalized free cash flow this business can generate?
Why the word normalized? What does that get you?
It forces the thinking past temporary cyclical peaks or troughs, or maybe large one-time capital expenditures. You want to understand the underlying sustainable earning power of the business, averaged over maybe a decade. That's much closer to intrinsic value than just the reported profit from the last quarter.
Okay. What else?
Ask, what's a plausible range of returns on incremental invested capital for this business going forward? If they reinvest profits, what kind of return can we realistically expect? And crucially, what does the balance sheet look like in a severe stress test? What happens in a deep recession scenario? Test the resilience.
And then bring it back to valuation.
Always ask. Given that normalized cash flow stream and the inherent risks of this specific business, what range of multiples would a rational, informed, long-term private buyer likely pay for the whole company? Frame it as a business purchase, not a stock trade.
And you had another key valuation question, kind of a summary.
Yes, perhaps the most important one to ask yourself and the analyst. At today's market price, what performance is already baked in? What am I implicitly being asked to believe about the future for this price to make sense? And what, realistically, am I actually being paid for today in terms of current durable earnings or cash flow? This forces a confrontation with the expectations embedded in the current price.
Okay, that's for interacting with brokers and analysts. Now, what about using data services, things like Bloomberg terminals, FactSet, etc.?
The mantra here is, data is vital, forecasts are optional, and often a dangerous distraction. Use these powerful services to inform your own analysis, never ever to replace it.
So the action plan isn't just to consume their data and forecasts.
No, it's to use their data to build and populate your own consistent analytical template. Focus it on things like normalized economics, judging the management team's capital allocation and track record over time, assessing balance sheet resilience, and arriving at your own independent valuation range.
And the competitive edge here comes from
Selective attention. Focus deeply on a short list of businesses that you can genuinely understand inside and out. Resist the temptation to have a shallow, forecast-driven opinion on hundreds of companies. Deep understanding of a few trumps shallow prediction of many.
All right. One more specialized area, investment bankers and the IPO temptation. New offerings, initial public offerings. They can be exciting.
They can be. And IPOs are necessary for capital formation, for growth, which is good for the economy overall.
Mm-hmm.
But as an investor considering buying into one, you must understand the inherent conflict of interest.
Which is?
The investment banker bringing the deal is fundamentally a salesman. They work for the seller, the company, or the insiders cashing out. They have a prospectus, yes, but their job is to sell the shares, often at the highest possible price.
So the buyer's protection is?
Skepticism. Rigorous, informed skepticism backed by deep due diligence. You need a checklist for any new offering you're tempted by.
What's on that checklist? What are the simple, sharp questions that cut through the inevitable hype?
Ask, why is this company going public right now? What's the motivation? Then, who specifically is selling shares in this offering, and why are they selling? Are the founders cashing out completely or retaining significant skin in the game? Then, get fundamental. What are the true cash economics of this business across a full economic cycle, not just in the recent rosy period often highlighted in the prospectus?
What else?
Ask, historically, What are the typical returns on invested capital for mature companies in this specific industry? Is this new company showing something sustainably different? And crucially, what percentage of shares are the insiders and original investors locking up, and for how long? Is there alignment?
And if the final honest answer to why buy this really just boils down to, well, because it's hot right now, everyone's talking about it, the momentum is incredible.
Then that is the absolute definition of heat without light. And you should almost certainly resist the temptation, regardless of how much FOMO, fear of missing out, you might feel, or what your friends or colleagues are doing. Many historical high-profile IPO failures, from dot-com era to more recent high-flying tech debuts that crashed, they were classic examples of intense heat, but very little fundamental light.
Resist the heat. Look for the light.
Exactly.
Okay, we keep coming back to discipline. You argue it's the ultimate, maybe the only sustainable edge in the market over the long run.
I firmly believe that.
Process and discipline.
So to enforce that discipline, you recommend running through an anti-mistake checklist before acting on any investment recommendation, even if it's your own brilliant idea.
Especially if it's your own idea. That's when biases are strongest. This checklist forces you to convert raw emotion or excitement into a rational, repeatable process.
Let's go through the 6 questions on the checklist. 1. Plan fit. Simple enough. Does this specific idea actually fit my written investment policy statement and my target asset allocation map? Yes or no?
2. Plain English. Can I explain the entire investment thesis, the business, its competitive advantage, why it's attractive now, and the key risks in one single, concise, easily understood paragraph? If you stumble or need jargon, the answer is probably no.
3. Valuation. Do I have a well-reasoned conservative estimate, a base case estimate, and maybe an optimistic estimate of the company's intrinsic value? And critically, is there a clear margin of safety between my conservative estimate and the current market price? Valuation is the anchor. It separates investing from speculating.
4. Behavior. Pause and reflect. What specific emotions am I feeling right now about this idea? Is it fear of missing out, FOMO? Is it panic selling driven by recent bad news? Is there an unusual sense of urgency being pushed on me? You have to identify the emotion before you dare to act on it.
5. Cost and tax. Get practical. What will executing this idea cost me in total dollars, including any advisory fees, commissions, bid-ask spreads, and potential taxes triggered over, say, the next 12 months? Quantify the friction involved.
And 6. Kill switch. This is about pre-commitment on the downside. What specific observable facts or data points, if they occurred in the future, would fundamentally prove my original thesis wrong and signal that I must exit the position? And crucially, will I pre-commit now in writing to respect that trigger, regardless of the stock price when it happens?
Wow. Okay, so if you can't confidently check all 6 of those boxes,
Then you don't really have a well-formed investment case yet. You likely have a feeling, a hunch, maybe an interesting narrative. Feelings are valuable information, yes, but they must be rigorously processed through this kind of framework before they are allowed to impact your actual portfolio.
that's a powerful filter. Let's maybe look at 2 short illustrative cases now to show how focusing on process rather than just short-term outcomes leads to success, aligning with those 2 investor identities we discussed.
Good idea. Let's start with case 1. The overwhelmed professional. Let's call her Dana, maybe 42 years old. High earner, saves aggressively, but honestly, she dreads market news, finds volatility stressful. Her goal is clearly lane 1. Standard results, minimal errors, minimal fuss.
So what does she do?
She recognizes her limitations and priorities. She hires a fee-only fiduciary planner, first order of business. They collaborate to write a short, clear, simple investment policy statement. They establish a straightforward, globally diversified portfolio mix, maybe total market equity index funds, high-quality bond funds. And they set up strict behavioral rules, mandatory annual rebalancing back to targets, absolutely no margin debt, no speculative options trading, and automatic pre-scheduled investments deducted from her paycheck every single month. Automation is key.
Okay, the system is set up.
Yeah.
Then what happens when the market inevitably hits turbulence, say a 20% drop?
This is where the advisor's value shines in lane 1. The planner doesn't wait for Dana to inevitably panic as she sees headlines. The planner proactively calls her first. They review the IPS together, remind her of the drawdown budget they agreed upon in advance when she was calm. This proactive behavioral coaching, this enforcement of the pre-agreed plan, ensures Dana stays invested. She avoids the classic, wealth-destroying mistake of capitulating to fear near the market bottom. She hits her long-term savings targets. The outcome is successful compounding, precisely because the process was designed for behavioral resilience and flawlessly executed.
Great example. Okay, case two, the enterprising engineer. Let's call him Lewis, maybe 35. He enjoys analysis. He wants to analyze individual businesses, maybe pursue above average returns, but he's realistic. He knows he has to earn the right to do that.
Right. So Lucis makes a real commitment. He dedicates, say, 5 focused hours every week to deep business research. No shortcuts. He builds and maintains a highly focused watch list, maybe only 15 companies that he feels he can genuinely explain inside and out, maybe on a single note card. And critically, he stress tests his own analysis rigorously. He might use broker research or data services, but only after he has formed his independent thesis and valuation. He uses external resources to challenge his view, not form it.
And what are his rules for acting?
His rules are strict, written down in his IPS. He only buys when his conservative estimate of value offers a compelling margin of safety relative to the current price. And position sizes are strictly capped. Maybe no single stock is ever more than 5–7% of his portfolio, regardless of conviction. He maintains that meticulous decision journal we talked about, reviewing it honestly every quarter. What went right, what went wrong, why. His personal measure of success is explicitly defined as the quality and consistency of his research and decision-making process, not the random fluctuations of his monthly P&L statement. He's successfully shifted his focus from prediction to disciplined execution.
Two very different paths, but both successful because the process matched the person's identity and goals?
Exactly.
Okay, so to maintain this kind of discipline over time, because it's hard, you need some systematic tools baked into your routine.
Yes, structure helps enforce discipline when willpower fades. First, maintain a quarterly calendar rhythm. Block out time every quarter to formally review your IPS and your asset allocation map. Rebalance back to targets if they've drifted beyond preset bands. Audit all the fees and taxes you've paid. See the dollar amounts. Archive your decision journal entries from the quarter. Make it a routine, almost bureaucratic requirement.
What else?
Schedule one annual red team session. This is powerful. Either you or ideally a trusted critical peer who understands your strategy actively argues the opposite case for your biggest investment positions. Force yourself or have someone else force you to confront the bear case, to challenge every one of your core assumptions. It's a potent antidote to confirmation bias.
I like that, using others to challenge you. What about automation?
Use default automation wherever possible, automatic contributions from your bank account or paycheck. Pre-scheduled rebalancing windows, VG. I will rebalance on June 15th every year unless markets are in crisis. Taking the emotional timing decision out of your hands is often hugely beneficial. And implement a strict cooling-off rule for new information. For example, absolutely no trading action within, say, 72 hours of receiving seemingly urgent, market-moving news or a hot tip without first writing a detailed note explaining why immediate action is genuinely justified by your long-term process rather than just reacting to noise.
Build-in pauses.
Exactly. Build in friction against impulsivity. And finally, make that identity work we did earlier really visible. Actually write a one-sentence identity reminder directly on your quarterly investment statements when they arrive. Something like, I am a long-term, fundamentals-minded business owner. My sustainable edge is patience and adherence to my written policy. Seeing it regularly reinforces the mindset.
Okay, let's try and wrap this up by summarizing those two honorable paths again. Defensive versus enterprising. Understanding clearly that one path isn't inherently better than the other. It's about fit.
Precisely. So the defensive investor, their world revolves around broadly diversified, very low-cost funds. Minimal frictions, low turnover, low taxes, low fees. Safety and preservation of capital come first. Patient, systematic rebalancing is their main activity. If they use an advisor, that advisor primarily acts as a guardrail and a simplifier, protecting them from complexity and behavioral errors.
And the enterprising investor. They might pursue more concentrated positions, but only in businesses they have rigorously studied and understand deeply. They demand relentless risk control through position sizing and valuation discipline. They rely on deep, independent valuation work as their anchor. If they use an advisor, that advisor acts more like a sparring partner and a speed governor challenging assumptions, ensuring boldness doesn't morph into recklessness.
And the final, maybe most crucial takeaway on this choice is simply this. The best path, the optimal strategy for you, is simply the one that you can actually follow consistently through full, difficult market cycles. Consistency in behavior will always, always trump complexity in strategy over the long haul.
That's a great summary point. Now, to make this really actionable for listeners, you suggested 2 short template scripts, things people could actually use or adapt when talking to a prospective or even their current advisor, depending on which identity they've chosen.
Yes, just starting points to frame the conversation clearly. So, script for the defensive investor. seeking standard results. You could say something like, my primary goal is steady, long-term wealth accumulation with standard market returns and, importantly, low regret from mistakes. To achieve this, I need your help specifically too. 1. Write and maintain a concise one-page investment policy statement with me. 2. Keep all costs, fees, taxes, turnover exceptionally low. 3. Actively prevent me from taking any actions that violate my written plan. 4. When recommending changes, provide clear customer analyses and valuation context, not just product pitches. 5. Show me my total cost clearly in dollars every year. And 6. Be prepared to say no clearly and firmly if I ever ask you to engage in speculation or deviate from our agreed plan.
Very clear expectations. Now, script for the enterprising investor seeking stress testing, how does that differ?
The emphasis shifts, you might say. I plan to conduct my own original analysis on potential investments first. Your core role, as my advisor, is primarily to act as a rigorous stress tester. I need you to challenge my underlying assumptions, help quantify specific risks I may have overlooked or underestimated, and ensure my position sizes and overall portfolio drawdowns remain strictly within the preset limits defined in my IPS. If I attempt to violate these written rules due to overconfidence or emotion, your job is to stop me.
Again, very clear about the role and expectations. Okay, final takeaways from this whole deep dive.
I'd say 3 main things. First, advice is most valuable when it functions primarily as a risk management tool. Its job is to reduce your mistakes, preserve your discipline, and bring clarity to critical decisions, especially under pressure.
Second,
Above-average outcomes, if they happen, are almost never the result of finding someone with above-average predictive powers or promises. They're usually just a quiet byproduct of sustained, disciplined, above-average behavior over very long periods.
and finally,
Judge potential advisors, not by their smooth confidence, their impressive office, or even their recent performance track record. Judge them by the clarity and rigor of their process and by the demonstrable financial alignment of their business model with your long-term interests.
get your own advice operating system installed today. Start asking these better, deeper questions. Give yourself the structure you need to compound wealth calmly and rationally over time.
If this episode helped you sharpen your thinking, please subscribe and like to support more educational lessons. It really does help others find the channel.
Thanks for joining Capital Allocation Lab. If you found this useful, like the episode and subscribe. It really helps us keep these lessons free. Until next time, be patient, be clear, and own businesses like an owner.
See you in the next episode.